Bitcoin has had 3 down years, 2014, 2018, and 2022. Now, you Bitcoin hodlers are going to be wealthy, but what's better than being wealthy? Being fudging filthy wealthy. And if you didn't get in on the early days of Bitcoin, Michael Terpin's strategy could be your path to significant gains and one of the last chances you have to implement it. Now, what do 2014, 2018, and 2022 have in common, other than many people watching soccer or football? They are in the third year of the 4-year Bitcoin cycle. The big question is, if we understood the psychology of these swings better and the tendencies in the cycles, couldn't we use it to our advantage to not just have more Bitcoin after each cycle, but have more fiat as well? That's exactly what Michael Terpin is now laying out in his book, Bitcoin Supercycle, where he backs up his 4 seasons model approach, a model that maps Bitcoin's price swings like seasons of the year. You could trade just twice per 4-year cycle and only needing to get within 30% of the tops and bottoms, and you'd have more Bitcoin had you just hodled. Hi, I'm Jack Allwell, hard money advocate, land junkie, and I'm here helping you understand what money actually is, understand your relationship to it, and explore ways to have your money work as hard, if not harder than you, and be more efficient. If you've been getting value from this channel, it would mean the world to me if you'd smash that subscribe button. And for this episode, please comment on how you'd use Terpin's strategy in this next cycle. So let's get into it. I've heard don't ever sell your Bitcoin, definitely don't try to trade it, hold for at least 5 years, all of which might be true for the right person. And I think the person that just holds will make a lot of money. When I heard Michael Terpin, however, talk on Kitco and explain that he is very bullish on Bitcoin, and at the same time, he said that he's been rotating in and out with the Bitcoin cycles, my ears definitely perked up. So who is Michael Terpin? Mr. Terpin founded the BitAngels Network and Transform Group PR in 2013, along with Coin Agenda and tokenized investor conferences and the advisory firm Transform Ventures. He was dubbed the godfather of crypto by CNBC in 2017 and has launched over 400 crypto projects, including Ethereum and Tether. It's not often I find people that are very bullish on Bitcoin and yet still trade it. So I was curious what he'd lay out. Bitcoin super cycle was laid out in what Terpin's calling books. So there's 5 books or sections. If you feel like you have a good sense of the Bitcoin basics and what money should be, I suggest you skip ahead to book 2 now. One of the things to become a fan of Bitcoin, or really any other asset for that matter, is you first have to understand the underlying problem. Perpetual money printing that results in people not only needing to work more if they're only saving in the fiat currency, but the ones that want to save need to spend time figuring out and analyzing what to convert their fiat currency into that will preserve their purchasing power over time. Now, money is supposed to be 3 things: unit of account, store value, and medium of exchange. So for unit of account, you may recognize terms like the euro, Japanese yen, and US dollar. These currencies have standardized units where one can see items priced in those terms. That box over there costs $20 US. Your shoes cost 100 euros. That matcha drink costs 550 yen. The unit of account essentially determines the world order. Picture Bretton Woods, New Hampshire, after World War II. 44 countries come together and determine the US dollar would become the reserve currency of the world. Other currencies were pegged to the US dollar, which was backed by gold, which at the time was $35 per ounce. Enter President Nixon, and in 1971, he took the US dollar off the gold standard, creating a current-day fiat monetary system. Fiat, meaning by decree, and is used because the government says so instead of demanding gold or silver or whatever people want to use. Also, government forces you to pay your taxes in fiat currency. Store of value can simply be summarized as something with the ability to preserve purchasing power. I say this so much, but it can't be stated enough. One shouldn't care about the dollar amount they have. They should care if they can acquire the goods and services over time at the same or better rate. Quick example, you're making $60,000 and your life costs $50,000 per year. That 50 encompasses rent or mortgage, food, travel, play, money, and then you have the 10K left over. The next year you start making 70K and are super excited. But your expenses go up from 50K to 70K, living the exact same life. Would it have been more fun to live in a scenario where your salary had stayed the same, but your living expenses actually went down to 45K? You'd be able to save more or experience something new. And that 10K you saved the year prior actually buys more, not less now. You may have seen this devastatingly famous chart of how the US dollar has lost its purchasing power dramatically over time. And mind you, this is a relatively good currency compared to virtually all other currencies. Thus, if you had stashed your money under your mattress all those years ago and pulled it out 70 years later, you'd be able to buy virtually nothing. And really think about that, because to some, that money originally had you sacrificing significant hours, days, weeks, months, or even years of your life. And that is why people are forced to quote unquote save in other ways. And perhaps when some say they're investing, what they're really doing is attempting to preserve the purchasing power of their leftover currency. They're not so much getting ahead as so much not losing more. Lastly, medium of exchange, having the ability to accommodate different items and type preferences for transactions. I want matcha and provide land services. I go to the matcha vendor, and while she does really like my land, she doesn't feel she has enough matcha to trade me at this moment. And her mind is just thinking about getting eggs for breakfast tomorrow. The egg guy lives kind of far away, and there's no guarantee he'll want my land either for his egg, even if my land is super cool. And I'd have to think about how many eggs he would need to give me to make a fair trade. Probably more eggs than I can carry. Simply, the medium of exchange idea eliminates these bartering type of transactions. If everyone agrees on using the dollars, I can pay the matcha lady for matcha, and then she'll have money that she can use tomorrow to buy her breakfast. I'm not going to touch too much on the science and or philosophy of Bitcoin, but thought I'd put them here if you were so inclined to continue digging in on some of the thoughts and circumstances that led to the creation of Bitcoin. I will just say the book was saying the bottom three guys have been thought to be Satoshi Nakamoto at certain times. So Nick Szebo's initials are even Satoshi Nakamoto's in reverse, and he shares the same birthday. So to go figure on that one. I think I'll probably add some of these readings to my reading list and do another video on them in the future. It looked like they're relatively short reads, and I think one of them was really just a couple paragraphs. Terpin finishes book one with the white paper with his commentary sprinkled in. Now, if you haven't read the Bitcoin white paper, you should definitely do that. And his point in including it in the book was so that you can answer yes when someone asks you if you've read the Bitcoin white paper. Parts are very heavy on the math, but it'll be good for you to get exposure to the language and general mechanics of Bitcoin. Book number 2 was understanding the Bitcoin cycles. Now, the item that stood out to me in this book was the psychology behind some of these ups and downs that we see in the cycles, and the Veblen Effect, which I never heard of, and which I'll get to in a moment. Now, mechanically, what could be driving some of these fluctuations? For the blocks of Bitcoin remain approximately 144 blocks per day, or about a block every 10 minutes. And every 4 years, the number of Bitcoins per block halves. The first cycle, there were 50 Bitcoins per block. The second cycle produced 25 Bitcoins per block. Third was 12.5. Fourth was 6.25. And now we're producing just 3.125 Bitcoins per block. After this cycle, over 20 of the 21 million Bitcoins will have been mined. And here's to show the decreasing nature. 10, almost half were mined in that very first cycle, 10 million here. Turpin's general theory is that scarcity is more important than all other factors, short of protocol failure or a decrease in the number of users. And that when a halving occurs, this causes shortages in new coins, and that is the first leg of new demand. Prices go up, and while normally prices going up would cause more supply competition or less demanded, and thus lowering prices, that doesn't happen with Bitcoin. Terpin is categorizing Bitcoin as a Veblen asset. The Veblen effect is the idea that certain goods attain a luxury status that makes them more valuable because of their higher price, making them a status symbol and increasing, not decreasing demand with increasing price. Terpin is talking to the loss to reality starting when the price of the prior cycle's high is reached, which is where Bitcoin spring turns into Bitcoin summer. In the cycle of 2012 to 2016, the prior all-time high of $30.40 was hit on February 26, 2013, which kicks off Bitcoin summer. Early December of 2013, we get our cycle high of over $1,000. In retrospect, we can think of this high being the start of Bitcoin fall and the end of Bitcoin summer. On the Bitcoin blockchain, one could see older wallets cashing out enough Bitcoin to buy a home or pay for years of expenses. The final capitulation event wouldn't come until January 2015, the bottom area and the best time to buy when all the sellers have left. Turpin's thesis was supported by 3 cycles that when the bull market is on, good news gets exaggerated and bad news gets ignored or minimized. The reverse is also true. When the bear market is on, bad news gets amplified and the good news gets ignored or minimized. Terpin dubbed this Turpin's news relativity paradigm. So Terpin is setting the stage looking at the prior 3 cycles, in that 2014, 2018, and 2022 followed similar shifts in sentiment. He's predicting the end of 2025 is likely to be the high of this cycle, followed by Bitcoin fall in 2026. It could be set off by something like headline 200K is too high, and then our favorite Bitcoin bear, Peter Schiff, harping as he has for years that Bitcoin has no value.
It's not money and it's not really currency. It's just a digital token, and it has no actual value other than the fact that people believe it has value.
Retail starts panicking and moving out of Bitcoin, as well as all of the Bitcoin ETFs and treasury companies, and into gold and AI. All this negative news during Bitcoin fall is amplified, and the positive news is undervalued or totally ignored. We continue to see a drop. Terpin thinks the floor for this 5th cycle is around $65,000. The whole psychology around the euphoria and capitulation really resonated with me reading this book. I had experienced the falls in 2014 and 2018, mind you, and I still remember that in 2021, I was thinking I was absolutely set for life and that nothing was going to stop Bitcoin from keep going up. And once again, Bitcoin humbled me in 2022. Now, book number 3 is The 4 Seasons of Bitcoin. This gets into what the seasons actually are. He did make a slight nuance that if in another like all-time high before the halving occurred, that you could consider spring to have started. But like these are kind of tough to time or view as a starting or ending point because you don't know until after the fact. But basically, once the prior all-time high is hit, summer starts, and then when you get to that ultimate all-time high, and then going down, that's really the end of summer into fall. You got this capitulation event like an FTX or something where all bad news is getting amplified, the good news is getting ignored. That's fall, and then there's an ending event where all the sellers have left, and then we get a slog up basically in Bitcoin winter, which is the best time to buy. This gives you a bit more visual representation of how these seasons work out. Here we have a prior all-time high. Isn't totally accurate, but the general trend is what we've seen in that a cycle low is still higher than the prior habit. So we get a halving, pop, That's the sign of Bitcoin fall, capitulation event here, and then great time to accumulate more, leading to the halving um, into Bitcoin spring. And as I had even acknowledged, Bitcoin fall is the toughest psychologically. It's tough to kind of admit that things might be too frothy or ignoring the negative news. And like I said, during Bitcoin summer, a lot of good news is getting amplified and the bad news is being ignored. He makes the point that since 2012, Bitcoin summer has ended, meaning we're hitting an all-time high in the fourth quarter of the year following the halving. And you can see it's November, December, and the year following the halving. So that would lead, if that trend continues, we're looking at Q4 2025 um, as of this year. So, and he's commenting that this has been a very narrow band. So it's kind of interesting. Basically, the ways you can play this are what he's proposing. So here he's laying out a couple of strategies. One is just a hodl, and then two is a more active approach. And hodl could mean just dollar cost averaging, just keep buying, and hold, don't sell. Trading in channels would involve selling or implementing options in some way. But just to give you a sense of what he was talking about, I decided to put a couple scenarios in just so you could see how it kind of works theoretically and how much risk you'd want to take. But basically, in this first hodl where you just let's say you just had one Bitcoin and you just held the whole time. Well, you have one Bitcoin out the whole time in US dollars. Um, it'll go up over time. His other point is you would be trying to time more the top in Bitcoin summer and then buy during what you think is the capitulation event or close to the capitulation event in the end of the fall or early winter. And this scenario has you getting within 30% of the top and bottom. So if you actually sold 30% below the all-time high here, and these are estimates that he used in the book, so that's where I'm getting these from, and then got within 30% of the bottom to buy back in. Well, now you'd go from 1 Bitcoin to 1.41. And obviously there is some fluctuation along the way because the next halving, if you then sell, you're actually down here. But then once the next cycle low comes, you'd be able to increase your Bitcoin even more. So obviously, if you're closer to timing the bottoms and the tops, you would obviously be able to acquire more Bitcoin over time. And this is showing that increase in Bitcoin accumulation over time, the closer and closer you get to those tops and bottoms. Bitcoin winter, after the capitulation event. So this time, and the time horizon has been getting longer for getting near the bottom. And this is a good point, actually. Fear is more rapid motivation than greed. And that when things are dropping, they're just like fire sales. Like people are just panicked. They're just trying to get out. So it really drops. But when there's the slog up, you have a longer window to accumulate Bitcoin. So maybe maybe if you don't feel comfortable selling, maybe you just alter how you're averaging in and maybe increase your Bitcoin buys in what do you think is Bitcoin win. So up till this point, we haven't really talked about what a super cycle is. This is commonly used to describe trigger-induced extended bull markets in commodities. And the super cycles that he had identified in prior years, mid-1960s to 70s, and you can see the triggers here. You got end of the gold standard. You got rise of China industrialization in the 90s to 08. And 2021, so for the question mark, massive stimulus. And this is the expiration, I don't know, petrodollar, where Saudi oil had to be priced in US dollars. So super cycles here are kind of the three, what they're saying, I guess, criteria. But it did seem kind of like fluffy language, often 3x or more. I don't really often, so not quite sure on that. Now, one of the questions then becomes, well, what could trigger or unload a super cycle for Bitcoin. So they got, number one is money printing, high inflation. He made the point that the U.S. government took 200 years to register the first $1 trillion of debt, and now we're printing $1 trillion every 100 days. Pretty mind-boggling rate. Hyperinflation once again. Seen that chart of the dollar losing value already in this presentation. Particularly in Africa and South America, they have extreme inflation rates, and I added the populations just so you can see how many people are affected. And these countries are over 500 million people. So that's nothing to scoff at. So some countries might be more incentivized, their citizens might be more incentivized to seek better options. Now, when he was writing this, he wrote this in 2024 after the halving, but so I don't know if any of this has changed, so take that for what it's worth. But he wrote ease of use. He was talking about how some of the crypto exchanges don't even allow U.S. citizens to have accounts, and that the ETFs and companies like Strategy would help people get involved through their brokerage accounts, and then they would at least indirectly have exposure to Bitcoin. And this other point, supply shock meets demand shock. I changed these numbers a little bit because the price changed since he wrote it, but there's not enough Bitcoin to accommodate 600 million new users buying, even $150. So, and just to give a sense of how that compares, he was saying that the average person on Earth owns 1 ounce of gold, which is like 3,600 right now. So that kind of gives you a sense how much could run up, and that the millionaires in the world, there's not enough to buy Bitcoin each. So book number 5 is $1 Million Bitcoin. And it's really just talking about how we get to $1 million Bitcoin. I mean, what I just showed in the prior slide kind of paints the picture of how there's just not a lot of it. And certain people would be more incentivized to go to it. We're going to have population gain here. It's saying there's projections 11 billion people by 2140 when they'll run out of mining new Bitcoin. And the rich want more Bitcoin than everyone else. They'll have a hard time getting it. To his point, I'd never heard it classified or categorized as a Veblen asset, but I kind of think that there might be some real truth to that, and how people, when the price goes up, then certain people migrate to it, and they do view it as a status symbol. I kind of am proud of my Bitcoin, so I can see other people doing the same. So in terms of what you can do, I would just say continue studying Bitcoin and getting financially educated. Figure out the best strategy for your goals, risk tolerance, and temperament. Maybe you want to use some of these strategies or change how your dollar cost averaging into Bitcoin, and subscribe to hear how I'm going to alter my Bitcoin strategy, particularly through the seasons utilizing options. So with that said, I'm Jack Allwild once again. I hope you got value from this episode, and please leave a comment below on how you'll use this information. Take care.